All right, welcome everyone to Talk Tickers, your regular deep dive into earnings calls. Today we're unpacking the Q1 2025 results from Quorum Information Technologies, ticker QIS.
Yep, we've gone through the transcript, the numbers, all the commentary. Our goal here is to really pull out what matters, give you the key takeaways.
Exactly. No need for you to sift through it all. So just as a quick reminder, Quorum provides tech solutions and services mainly for vehicle dealerships, OEMs too, across North America.
Right. They have this integrated suite. I think it's 13 different software products now, and they've got a pretty strong position, especially up in Canada.
Yeah. Something like 40% of franchise dealerships in Canada use at least one of their solutions. Yeah. Which is, significant penetration.
And they always highlight this cross-selling opportunity. They figure there's potentially $54 million in annual SaaS revenue just within their existing Canadian dealer base if they sold them more products.
Which is huge when you compare it to their current recurring annual SaaS revenue, which came in around $28.9 million this quarter.
Yeah, so lots of runway there, theoretically.
Okay, let's jump into the Q1 results then. The top line, well, it grew, but maybe not spectacularly. Total revenue was up just 1% year over year, hit $10.2 million.
And that core SaaS revenue, the software side, was also up 1%, reaching $7.2 million.
Their BDC segment, that's the Business Development Center Services, did a little better, up 4% to $2.6 million.
So, yeah, growth, but modest, like you said, that 1% SaaS growth. It does seem a bit slow, maybe, given that cross-sell potential we just talked about.
What did they say was driving it?
Management pointed to a few things, some price increases kicking in, continued cross-selling efforts, and adding some new customers. For the BDC growth, it was mostly about bringing on new BDC clients.
Okay, so revenue creeping up. But profitability, that was a different story this quarter compared to last year, wasn't it?
It was, yeah. Adjusted EBITDA, that took a pretty significant hit, down 29% to $1.5 million.
Which pushed the margin down quite a bit, from 21% last year to 15% this quarter.
Right. And cash EBITDA saw a similar trend, down 27% to $1 million. That's a 10% margin, down from 14% in Q1 last year. So definitely a noticeable squeeze on profitability.
So what's behind that squeeze? Did they break it down?
They did, yeah. And it's important to understand the pieces. They said about 2% of that adjusted EBITDA margin decrease, so, a third of the total drop, was because of an internal accounting decision.
An accounting decision?
Yeah. They decided to expense more of their software development costs in the quarter, rather than capitalizing those costs onto the balance sheet.
Okay, so that hits the reported profit number now, but it's maybe a more conservative approach. Doesn't change the actual cash spent on development in that period.
Exactly. It impacts the reported EBITDA margin, but not necessarily the underlying operational spending trend for that specific item.
Got it. So that accounts for 2% out of the 6% drop in adjusted EBITDA margin. What about the other 4%?
Well, that remaining 4% decrease and the drop in cash EBITDA margin too, they said that was primarily driven by lower overall gross margin.
Okay, where did the gross margin pressure come from?
Two main areas. On the SaaS side, gross margin slipped a bit, from 68% down to 66%. They specifically mention higher third-party costs as the reason there.
Okay. And the BDC?
That saw a more significant drop. BDC gross margin fell from 20% last year down to 15% this quarter.
Wow, 15% from 20%. That's quite a decline for the BDC segment. What happened there?
Their explanation was that they proactively built up their staffing levels in the BDC. They hired and trained people anticipating more new customer demand for those services.
So they staffed up before the revenue fully landed, investing ahead of the curve, basically.
That seems to be the story. So you get the cost hitting the P&L now, pressuring the margin, with the expectation that the related revenue will follow and utilize that capacity.
That makes sense. Anything else driving the margin pressure?
They also mentioned, the usual suspects to some extent, general external inflation, the cost of bringing on a key new executive hire, and their regular annual merit-based salary increases for staff. So it's a mix, really. Accounting choice, some operational cost bumps like third-party fees, and that strategic BDC investment.
Okay, so given those pressures, not surprising they talked about cutting costs too.
Right. They highlighted they've already found and implemented $1.3 million in annualized savings. They expect to see the full benefit of those savings flowing through by Q3 of this year.
And where are those savings coming from?
It's across a few areas. They mentioned a gross margin improvement plan, which you'd hope helps offset those higher SaaS costs and maybe improves BDC efficiency as volume picks up.
Okay.
Also savings on office leases, cutting costs with some third-party service providers, and just other general operational improvements. So they're definitely pulling levers to try and, claw back some of that margin.
And they did seem quite focused on that BDC segment, despite the margin dip this quarter. They talked a bit about their vision there.
Yeah, it sounds strategically important. They're looking at using more technology, specifically AI, to handle a lot of the initial customer outreach for dealers.
Automating the first contact.
Sort of, letting the AI do the broad outreach and then having their human BDC agents focus on the consumers who actually show interest, engaging them, booking service appointments, finding upsell opportunities.
So making the agents more efficient, focusing them on higher value interactions.
That seems to be the goal. Plus other tech to boost efficiency. And they mentioned demand is high from dealers right now for these BDC services and the related service CRM software. So that staffing investment, it fits into this bigger picture of modernizing and scaling the BDC to meet demand and hopefully improve margins long-term with tech.
Okay, that connects the dots on the BDC side. Now, shifting gears a bit, they really emphasize the balance sheet improvements.
Oh, absolutely. This was probably the biggest positive highlight financially. They've made huge strides in paying down debt.
Yeah, the numbers are pretty stark.
Weren't they? Their total debt to cash EBITDA ratio, it's down to just 1x as of March 31st.
1 times compared to what it was.
Compared to 2.5x a year ago, March 2024. And it was even higher, 3.7x at the end of 2023. So that's a massive deleveraging in, 15 months?
Really significant. And they're keeping it going, right? Even after the quarter ended.
They are. They mentioned making another prepayment in May, $500,000 on their BDC capital loan.
Okay.
And they laid out the plan. Pay off the remaining several $0.9 million cash flow loan completely by the end of this year, 2025.
Yeah.
And keep making the required 15% annual prepayments on that $2.8 million mezzanine loan until it matures in 2027.
Right, and they can't really pay more than 15% on that mezz loan without penalties, correct?
That's what they noted, yeah. Significant penalties if they try to prepay more than the 15% annually on that specific loan. So the focus for extra cash is on the other debt first.
So bottom line, the balance sheet is much, much stronger. What does that actually unlock for them?
Flexibility. That's the key word management used.
Yeah.
A stronger balance sheet gives them much more latitude for strategic capital allocation decisions down the road.
Right. Options they maybe didn't have when debt was higher.
Exactly. It opens the door to things that were likely off the table before.
And what kind of options did they mention now that they have this flexibility?
They outlined a few possibilities. One is reinvesting in organic growth. Maybe hiring more salespeople, pushing harder into the U.S. market, or grabbing more share in Canada.
Okay, investing in the core business.
Another option is M&A, pursuing accretive acquisitions, buying companies that could add new tech or give them faster access to new customers or markets.
Makes sense.
And the third path they mentioned was returning capital to shareholders, things like potentially share buybacks or maybe even initiating a dividend at some point in the future.
So organic growth, acquisitions, or returning capital. Sounds like good options to have.
Yeah.
But there was a but, wasn't there?
There was a significant but. Right after outlining these possibilities, they introduced a major external challenge that's making them pause and think carefully.
And that's the automotive tariffs.
Precisely. The new tariffs being brought in by both the U.S. and Canadian governments, they pointed out the situation is still kind of fluid. The exact impact isn't crystal clear yet.
Right.
But the concern is these tariffs could lead to lower overall vehicle sales volumes, which obviously creates headaches for dealerships and the manufacturers.
Yeah, they might have to raise prices, hitting affordability, or absorb the costs themselves, which hits their margins and market share.
Exactly. And this big cloud of macro uncertainty driven by government policy is definitely influencing how Quorum thinks about deploying that capital they've freed up. It affects the timing and maybe the type of strategic moves they'll make.
So if their dealer customers are potentially facing these headwinds from tariffs, how does Quorum actually help them navigate that kind of environment? What's the pitch?
Well, management expressed confidence in dealers. They said dealerships are resilient, creative. They found ways through the pandemic supply chain chaos, right?
Sure.
And they believe Quorum's tech suite is well suited to help. Their software helps dealers drive demand not just for new cars, but critically for service appointments too. It helps improve their sales closing rates and helps boost gross margins across the board, both in sales and in service and parts.
And they put a lot of emphasis on that service and parts business, didn't they? What they call fixed operations.
They really did. They stressed how crucial fixed ops is for dealerships. It's often a more consistent, profitable revenue stream than volatile new car sales.
Especially if tariffs slow down new car sales, where people decide to keep their current cars longer.
Exactly. In that scenario, the service and parts business becomes even more vital for the dealership's health. And Quorum's tools, like their service CRM and the BDC services we talked about, directly support that critical, profitable part of the business.
So the argument is, their tech helps the most resilient part of the dealership, making Quorum itself more resilient, even if the new car market gets choppy.
That seems to be their position. Their solutions address core operational needs and bolster the dealership's profit engine, regardless of new car sales fluctuations.
Okay, so it really paints a picture of a company doing a lot internally, fixing the balance sheet, cutting costs, refining the BDC, while facing these pretty significant external pressures, mainly the tariffs.
That sums it up well. Internal discipline and operational improvements meeting external caution due to macro uncertainty.
That focus on fixed operations and the tech supporting it brings up kind of an interesting side thought, doesn't it? They talked about AI in the BDC for service outreach.
Yeah, automating some of that initial contact.
Right. But think about the traditional service advisor role inside the dealership. You know, the person you talk to when you bring your car in. They diagnose issues, explain repairs, sell additional services. They're absolutely key to fixed ops profitability.
Totally. They manage that customer interaction and drive a lot of the service revenue.
So here's the thought. With Quorum pushing AI in the BDC for service outreach and having their service CRM tools, how might that AI technology eventually impact that core service advisor role itself?
Interesting question.
Could it start automating parts of what they do? Maybe making them more efficient, perhaps? Or could it potentially disrupt the role more fundamentally? Or maybe it just empowers them, give them better tools to, engage customers and sell effectively.
Yeah, the call focused on AI for the outreach part of the BDC, but the downstream implications for the person actually interacting with the customer in the service lane. That feels like a really interesting area to watch as this tech evolves. It wasn't spelled out, but the pieces are there.
Definitely something to keep an eye on.
Yeah.
Okay, we've covered the call itself. Now let's step completely outside for a second. This is where we do our highly speculative what-if scenario.
And let's be absolutely clear. This is purely hypothetical brainstorming. It is not financial advice. Not even close. Just mental gymnastics.
Absolutely. Zero recommendation implied. So building on what we heard, Quorum deleveraged, got flexible. BUT faces this big tariff uncertainty potentially hitting the auto sector.
Okay, I see where you might be going. A complex situation.
Right. So purely theoretically, imagine you thought the tariffs would cause significant volatility across the auto industry, hitting stocks exposed to new car sales. But you also believed Quorum's fixed ops focus and strong balance sheet would make it relatively more stable, maybe less volatile than its peers.
A very specific thesis.
Very specific, very hypothetical. An absolutely outlandish, high-risk, purely illustrative trade idea could be something incredibly complex involving options. Maybe like an iron condor or a similar strategy designed only to profit if Quorum's stock price stays within an extremely tight range, say, plus or minus, just 3%, while broader auto sector volatility explodes because of tariff news.
Wow. Okay, so you're not betting on direction, you're betting on extreme relative calmness in Quorum amidst a wider storm, using derivatives that profit from low volatility in that specific stock against high volatility elsewhere.
Precisely. It's a bet on very specific price and action, coupled with market action. The timing would need to be perfect, the predicted range impossibly narrow, and the risk is immense. You could lose everything very quickly if the stock moves just slightly outside that tiny band.
It's financial tightrope walking, pure speculation based on the call's themes of internal strength versus external uncertainty. And again, we have to stress,
This is not financial advice. Seriously, trading involves substantial risk. Always talk to a qualified financial professional before making any investment decisions.
couldn't say it better.
Okay, bringing you back home for the wrap-up. Quorum's Q1, modest revenue growth, profitability squeezed by accounting choices, costs, and BDC investment. But huge progress on the balance sheet, creating flexibility.
Right, but that flexibility is tempered by the big question mark around automotive tariffs and their impact on dealers.
Still, management feels their tech, especially supporting the resilient fixed ops business, positions them and their customers well to handle potential challenges.
It's a narrative of internal progress meeting external headwinds, with a cautious eye on the future.
Exactly. Well, that's our deep dive on Quorum's Q1 call. Hope they gave you the insights you needed.
Yeah, hope it was helpful.
Thanks for tuning in to Talk Tickers. We'll catch you on the next one.